Next guest has a $173 price target on the stock. That's above the street median price target of $167. Joining us now to discuss the results, we want to bring in Antoine Chikave. He is a New Street Research Technology Infrastructure Analyst. Antoine, it's great to have you back here on Yahoo Finance. So it looks like initially there was some disappointment playing out in the street from the numbers that we saw. And here we are this morning, a bit of a reversal. I'm curious what your biggest takeaway is from this report.
Yes, thanks a lot, Sean and Brad, for having me. So yes, I would just reiterate that Nvidia printed a strong third quarter, with a solid 17% sequential growth for data center. That's above expectations, and the guide for 4Q was strong as well. That implies another 10% sequential growth. And on one hand, you have demand for Hopper that remains very strong, broad-based. You have, H200, Nvidia's latest Hopper GPU that's ramping very well. And on the other hand, you have the Blackwell ramp that's very much on track. Nvidia, is planning to exceed its previous guide of several billions in 4Q. And most importantly, demand is set to exceed supply for several quarters in 2025. And so now I think that the key question is what happens in 2020.
How far out do you think investors are apt to look when evaluating this company? Because you continue to hear on the call that you've got staggering demand for Blackwell, incredible demand, they went on to say. Colette Kress, the CFO and EVP over at Nvidia, also saying Hopper demand is exceptional. So all of this and the superlatives that they layer on to the demand that they're seeing, how far out do you think investors should be keeping in mind with regard to some of these demand projections and then layering that into what seems like a fair valuation for them to get in at?
Yeah, so again, I think now the key debate is what happens in 25, right? And on that front, I think I would say two things. First, there are no signs of overcapacity building for GPUs. On the contrary, you have all the latest models like OpenAI's O1 with a chain of thought putting pressure on compute requirements. That's driving very strong demand at the moment. And we also monitor very closely hyperscale capex, and hyperscalers are indeed on a trend to spend enough for Nvidia to beat next year. And the second thing is really Nvidia's supply chain and all the data center power capacity that is increasing at a very rapid pace. And so you have Nvidia who is carefully allocating clients based on power capacity. So that's really unlikely to create like a bottleneck at an industry level next year. And so here, the conclusion is that there is no bottleneck preventing Nvidia from meeting its expectation, from meeting consensus expectations next year, and even buy-side expectations as well, which we estimate, maybe are in the $200 billion for data center. So bottom line, yes, is Nvidia is very well positioned for 2025. They're set to generate, over $4 of EPS. And even if we expect growth to slow materially beyond, we still see Nvidia approaching, $6 of EPS. And how do we value that? Well, over the last 10 years, Nvidia has traded on 38 times forward earnings. And so if you put like a 35 multiple on these $6 of earnings, well, and you discount that back to today, that still, gives you quite a bit of upside. And that's how our $173 target price is based on.
Following its Q3 earnings, Loop Capital analyst Ananda Barua maintains a buy rating and a $175 price target for Nvidia. In a research note, the analyst informs investors that although Q4 guidance suggests that there is probably a slight Hopper pause before Blackwell launches in Q4, the company's revenue and earnings showed material upside in the quarter. Additionally, it appears to be in line with the firm's belief that Nvidia has been able to pull a little more Blackwell forward into Q4 than was predicted a few months ago. The expected demand trajectory remains intact. According to the company's projections and commentary, Loop continued. Baird maintained its outperform rating on the shares and increased the company's price target for Nvidia from $150 to $190. The company highlighted the very high demand and RFQs for Blackwell and stated that despite the complexity of system deployment, there are no serious problems like overheating affecting demand. As generative AI offers a completely new demand layer, Nvidia anticipates that global data center modernization, from coding to generating AI, will continue for the next 5 years, so there won't be any slowdown in demand. Following the bell on Wednesday, Nvidia announced third-quarter earnings that exceeded forecasts due to the robust sales of its powerful AI chips, which its CEO, Jensen Huang, known as the Age of AI. According to market capitalization, Nvidia is the biggest publicly traded company in the world. The company reported $35.1 billion in revenue and $0.81 earnings per share. Analysts were expecting $33.2 billion in revenue with an EPS of $0.74. Additionally, Nvidia stated that it expects fourth-quarter revenue of $37.5 billion, plus or minus 2%. That is somewhat more than the $37 billion that Wall Street had anticipated. As investors considered the outlook, Nvidia's stock price fluctuated Thursday morning, reaching an intraday high before hovering around the flat line. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication. So if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
NVIDIA CEO Jensen Huang telling analysts that production for the company's highly anticipated Blackwell chip is, quote, in full steam, but demand still outpaces supply.
The supply chain team is doing an incredible job working with our supply partners to increase Blackwell, and we're going to continue to work hard to increase Blackwell through next year. It is the case that demand exceeds our supply, and that's expected as we're in the beginnings of this generative AI revolution, as we all know.
Joining us now, we want to bring in Ben Beharin. He is a Creative Strategy CEO and Principal Analyst. Ben, it's great to have you. I know you own NVIDIA through some of your mutual funds. I'm curious how you're looking at the results that we got last night, some of that commentary about the relentless demand, it sounds like, here for NVIDIA's chips, and maybe what that signals in terms of an investment opportunity.
Yeah, I mean, I think the big thing is they're going to be up against a lot of supply constraints, just because we are working with an advanced manufacturing process for Blackwell, and from that regard, right, TSMC is scaling a new process in terms of advanced packaging. So as that ramps, I think some of those supply constraints will start to ease. But the bottom line is, just from the demand we see from the hyperscalers, we talk to a lot of people in cloud. We talk to a lot of CIOs and CTOs investing in these enterprise AI workflows. We're confident there's going to be a continued demand cycle here for at least the next year, if not into calendar 26. And I would expect that NVIDIA remains just supply constrained throughout that time, if not longer.
Do you expect the spends or the purchase orders that they're receiving from their customers to remain at the same level? And I guess I ask that because we're seeing this demand really show up in even some of the larger kind of S&P 500 targets that we're seeing from banks and investment firms as well, who are talking about the level of spend that AI is expected to receive over these next several quarters.
Yeah, I think the big thing there, and this is just reflected in the hyperscalers' CapEx increase in their spend, is when you just look at the demand today for AI, this is a large amount of organizations just piloting and doing projects. So this is not being deployed yet to every person in their enterprise, nor is this being deployed to every person on the planet with a computer who are using these functions on a regular basis. So that's why you look at this and say we are in the very, very early stages of a transformational moment in computing, and the vast majority of data centers are not AI factories, as Jensen likes to say. We are in the midst of an early transition from general purpose servers, which things that just run the internet, Walmart.com, Amazon.com, Netflix, et cetera, to these AI servers. And that's single digit penetration in terms of the general data center now. So we have a long ramp of spend as they start to transition those data centers from general purpose servers to AI servers. And NVIDIA is going to be one of the main beneficiaries of that over that timeline. And that is a 2-3 year arc if you just look at where CapEx is today.
When it comes to data centers and the creation of artificial intelligence, AI, NVIDIA is the world's top supplier of graphics processing units, GPUs. GPU sales alone have increased Nvidia's worth by $3.2 trillion in the last 2 years. After the market closed on November 20, the corporation recently released its fiscal 2025 third quarter earnings, which completely exceeded Wall Street's forecasts. A new generation of GPUs built on its potent Blackwell architecture has just begun to be shipped, and demand is far exceeding supply. Even so, after-hours trading after the third quarter announcements saw a 2.5% decline in the shares. Here are some reasons why any downturn could be a buying opportunity, as I believe the shares will surge over the following 12 months. Central processing units, CPUs, which were excellent for efficiently managing a limited number of specialized activities, were used in the construction of data centers in the past. But because GPUs are made for parallel computing, they can execute multiple tasks at once with a very fast throughput. This is essential for AI inference and model training, as those tasks call for circuits that can quickly analyze and absorb trillions of data points. Up until now, the preferred option for AI development has been GPUs based on Nvidia's Hopper architecture, such as the H100 and H200. Tens of thousands of those GPUs are purchased by data center operators such as Microsoft and Amazon, who then rent their processing capacity to companies and AI developers who lack the funds to construct their own infrastructure. A single H100 can sell for up to $40,000. Now, Nvidia's Blackwell GPU architecture ushers in a new era of AI computation. AI inference may be completed 30 times faster by the Blackwell-based GB200 NVL72 system than by the comparable H100 system. According to a recent estimate, a single GB200 GPU in an NVL72 system costs about $83,333. This means that developers are obtaining a 30-fold boost in AI inference capability for only a 2-fold price increase over the H100. To put it another way, the Blackwell GPUs should lead to a remarkable rise in cost efficiency, enabling more companies and developers to adopt the most cutting-edge AI large language models, LLMs. In the third quarter, Nvidia sent 13,000 Blackwell GPU samples to clients. Oracle clients will soon have access to compute clusters with an incredible 131,000 Blackwell GPUs, and Microsoft, Dell, and CoreWeave have already begun constructing data centers based on Blackwell technology. According to Nvidia CEO Jensen Huang, demand for Blackwell is staggering. In the coming months alone, GPU shipments may increase by more than 20 times, but I'll go into more detail about that later. Wall Street experts had predicted that Nvidia would generate $33.2 billion in total sales going into the third quarter report. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
And obviously, valuation concerns we have seen creeping into the market. Do you then think it sounds like maybe the valuation is justified given that opportunity that lies ahead?
Yeah, I think it just goes back to the point as to what happens when enterprises and really every service company starts deploying this at scale, because it's not today. And once we start seeing this move into full deployment, which if you read a lot of commentary from CIOs and CTOs in terms of their spends with their budgets, that's going to be mid to end of next year that they expect to start rolling out those broader AI projects at scale. And that's not even to their entire enterprise. That's to Salesforce. That's to marketing, that's to engineering for coding. Once this really fully moves out to really every knowledge worker, if you will, and really beyond, like the scale for that is going to be significant. And so I think we'll start to see those ROI justifications, those spends start to move to software on that timeline, again, mid to late next year. But we're in still this just build infrastructure stage here. And it's still going to be a multi-year cycle of infrastructure build.
And with that multi-year cycle of infrastructure, are we focusing specifically on data centers, or is there something else that needs to be factored into that infrastructure, such as energy powering those data centers. We've even heard Oracle and some of the other major tech companies talk about nuclear reactors and investing there to make sure that these data centers that have thousands, tens of thousands of chips in them could eventually see, maybe 1 million chips, and that would require much more power.
Yeah, so the biggest trends here, right, is all of this does consume more power. So they are working on obviously bringing in more power. This also requires a new way to cool. So you're hearing a lot about liquid cooling coming into all of these different parts of the data center. That's not something they had to do before. So they're having to add piping, and they're having to add a whole new slew of electricity, ways to deal with that water. So we're in a redesign, if you will, rethink of the architecture of data centers. And that's causing a ton of different implications throughout the entire supply chain, right? People who build racks, all forms of infrastructure for those buildings, and they're getting bigger. They are expanding the sizes of their data center with some of these new builds. So it's really a fascinating time because the infrastructure change that's needed here is so significant, and I think that's why you're seeing so many projects and so much initial spotlight on just how expensive of a problem this is. But everybody believes it will pay off. But like I said, that's why this is a multi-year transformational cycle in infrastructure.
With $35.1 billion in sales, a 94% increase over the same period last year, Nvidia nailed it. Of that total, $30.8 billion, or 112% growth, came from the data center industry alone. GPU sales were responsible for most of that money. Additionally, the company's guidance for the current fiscal 2025 fourth quarter surpassed expectations. In contrast to Wall Street's projection of $37.1 billion, it informed investors that it expects to generate $37.5 billion in total sales. Although he did not provide a precise amount, Huang now states that Blackwell GPUs are on track to surpass his earlier prediction that the business would generate several $billion in revenue during the fourth quarter. As previously stated, the stock experienced a little decline in post-hours trading subsequent to the publication of its third quarter report. That's unexpected because the business exceeded all expectations. However, the stock has increased 202% this year, so it's possible that some investors just chose to cash in on their gains. Now let's discuss valuation. Nvidia's stock is trading at a price-to-earnings ratio, P/E, of 54.2, which is based on the company's trailing 12-month earnings per share of $2.62. In actuality, that represents a discount to its 10-year average P/E of 58.6. The crucial figure is that Wall Street projects Nvidia's profits per share to reach $4.21 in fiscal 2026, which begins in a few months. This puts it at a forward P/E of 33.8, meaning that in order for its P/E to trade in line with its 10-year average of 58.6, its stock will need to rise 73% during the course of the following year. Wall Street's fiscal 2026 earnings prediction may be overly conservative, in my opinion. As I previously stated, during the third quarter, Nvidia shipped 13,000 Blackwell GPUs to consumers. The company is expected to ship up to 300,000 units in the last 3 months of 2024 and up to 800,000 units in the first 3 months of 2025, according to Morgan Stanley. To put it another way, Nvidia's current fiscal 2025 fourth quarter might see a 20-fold increase in Blackwell shipments over the third quarter. According to Morgan Stanley, a substantial amount of the $300 billion that Microsoft, Amazon, Alphabet, and Meta platforms are expected to invest on AI data center infrastructure next year will go into GPUs. These are only 4 of Nvidia's most important clients. Other high spenders include OpenAI, Oracle, and even Tesla. As a result, I believe there is a very good likelihood that the stock will rise at least 73% in the upcoming year. As always, sharing your thoughts and insights in the comments section can foster a more informed community discussion, helping everyone navigate the complexities of investing in this dynamic sector. Stay ahead of the game with the latest stock market news, data, and important updates. I share valuable insights and real-time information on my Telegram channel, ensuring you're always informed before everyone else. If you want to keep up with the fast-paced world of investing, open the description below, click the link to my Telegram channel, and join our growing community.